Alright folks, let's talk taxes. Specifically, those pesky taxes related to your favorite payment apps. You know, the Venmos, the Cash Apps, the PayPals of the world. In the digital age, even your morning coffee purchase leaves a digital trail. And guess what? The IRS wants in on the action. Enter Form 1099-K. The IRS's way of keeping tabs on your side hustles, online sales, and any other income generated through these platforms. Think of it as a digital paper trail for your digital dollars. This form isn't new, but the rules surrounding it are changing faster than Instagram trends. So buckle up as we break down everything you need to know about 1099K's, reporting thresholds, and how to stay on the right side of the tax man. Because trust me, the last thing you want is a surprise audit from Uncle Sam. In a nutshell, Form 1099K is used to report payments received for goods and services through third-party payment networks. Essentially, if you're using these apps for more than just splitting bills with friends or sending birthday money to your nephew, the IRS wants to know about it. They want to ensure that all income, no matter how small, is properly reported and taxed. So, whether you're a freelancer, a small business owner, or just someone who occasionally sells items online, understanding these tax implications is crucial. Now, here's where things get interesting. The IRS has been tinkering with the reporting thresholds for 1099Ks, which has caused quite a bit of confusion and, let's be honest, a little bit of panic among taxpayers. Remember the good old days, aka pre-2024, when you only had to worry about a 1099K if you raked in over $20,000 and had more than 200 transactions? Yeah, those days are gone. The landscape has changed dramatically. Fast forward to 2024 and the threshold dropped to $5,000. Still a decent chunk of change, right? But it doesn't stop there. Well, hold on to your hats, because in 2025, that threshold plummets to a measly $2,500. That's right, just a little over $2,000 in transactions, and bam, you're on the IRS's radar. And from 2026 onwards, brace yourselves, because unless Congress intervenes, the threshold drops to a mind-boggling $600. That's less than a monthly rent payment in some cities. It's a significant change that will affect many. So, what does this all mean? Simply put, the IRS is casting a wider net, and more people than ever will be receiving 1099K forms in the coming years. But don't freak out just yet. There are ways to manage this. Let's dive into who exactly gets these forms and why it's crucial to file them correctly. Understanding this can save you a lot of headaches. So, who exactly should be bracing themselves for a 1099K in their mailbox? Let's break it down. If you're someone who uses payment apps to receive payments for goods or services exceeding the reporting threshold, then congrats, or maybe not. You've earned yourself some extra paperwork. This includes popular apps like Venmo, Cash App, and PayPal. This applies to everyone from freelancers and independent contractors to online sellers and small business owners. Essentially, anyone who gets paid through these platforms for their work or sales. Basically, if you're using these apps to get paid for your hustle, the IRS wants its cut. They are keeping a close eye on these transactions. Now, here's the catch. Even if you don't meet the threshold, you're still legally obligated to report all taxable income to the IRS. Ignoring this can lead to complications. Think of the 1099K as a friendly reminder, or maybe not so friendly, from Uncle Sam that he's watching your money moves. It's a nudge to stay compliant. Filing your 1099K correctly is crucial for a number of reasons. It ensures that your financial records are accurate and up to date. First and foremost, it keeps you on the right side of the law. Compliance is key to avoiding legal troubles. Tax evasion is a serious offense, and nobody wants to mess with the IRS. The consequences can be severe. Secondly, accurate filing ensures that you're only paying your fair share of taxes. You don't want to overpay or underpay. Remember, just because you receive a 1099K doesn't mean every penny is taxable income. There are nuances to consider. We'll delve into deductible expenses and non-taxable transactions later. Stay tuned for more details. Not all payment apps are created equal when it comes to IRS reporting. While Venmo, Cash App, and PayPal are all subject to 1099K reporting, there are some key differences to be aware of. Zelle, for example, is exempt from 1099K reporting. Why? Because Zelle transactions occur directly between bank accounts, bypassing the third-party network that triggers the 1099K. Venmo and PayPal, on the other hand, allow users to tag payments as personal or business. This can be helpful for separating taxable income from personal transactions, but it's important to be diligent about tagging correctly. It's also worth noting that some states have their own reporting thresholds for 1099Ks, which may be lower than the federal threshold. For instance, Maryland and Massachusetts have a $600 threshold for 2024. The world of payment apps is constantly evolving, so it's essential to stay informed about the specific rules and regulations governing each platform you use. Section 5. Oops, wrong form. How to handle an incorrect 1099K. We're all human and mistakes happen. So what happens if you receive a 1099K that's incorrect? Don't panic. The first step is to contact the payment network that issued the form. They can help you correct any errors and reissue the form with the accurate information. It's crucial to maintain good accounting practices to avoid discrepancies in the first place. Keep meticulous records of all your transactions, clearly separating personal expenses from business income. If you've already filed your tax return and later discover an error on your 1099K, don't fret. You can file an amended tax return to correct the information. Remember, dealing with the IRS can be intimidating, but it's always best to address any errors or discrepancies promptly and honestly. Transparency is key to a smooth and stress-free tax season. Alright, let's talk about some common non-taxable transactions. It's important to know that not every payment you receive through Venmo, Cash App, or PayPal is subject to taxes. For instance, if you're receiving money as a gift, that's typically not taxable. Reimbursements for shared expenses, like splitting a dinner bill, are also non-taxable. And if you're just transferring money between your own accounts, there's no tax implication there either. Knowing these distinctions can save you a lot of hassle when tax season rolls around. Now let's dive into best practices for managing your personal and business finances. One key tip is to keep your personal and business transactions separate. This can be done by using different accounts or platforms for each. It will make tracking your income and expenses much easier. Also, consider keeping detailed records of all your transactions. This can help you identify which payments are taxable and which are not. And finally, regularly review your financial statements to ensure everything is in order. These practices can help you stay organized and avoid any potential tax issues down the line. Staying informed about tax laws is crucial. Tax regulations can change frequently, and what was true last year might not be the case this year. By keeping up to date with the latest tax laws, you can ensure you're complying with the IRS requirements and avoid any penalties. Plus, understanding these laws can help you make better financial decisions. For example, knowing what deductions you qualify for can save you money. So make it a habit to stay informed and consult with a tax professional if needed. So, there you have it. Understanding the ins and outs of IRS reporting for Venmo, Cash App, and PayPal can save you a lot of trouble. Make sure to keep your transactions organized, stay informed about tax laws, and consult with a professional if you have any doubts. Thanks for watching, and don't forget to like, share, and subscribe for more useful tips and information. Stay financially savvy.